Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
Have you ever noticed how some of the biggest stock market winners start out quietly, almost unnoticed until one major deal or earnings report suddenly changes everything? That's exactly what's happening right now in two completely different corners of the market. One company is deep in the world of AI infrastructure and digital power, building the kind of backbone that makes artificial intelligence even possible. And the other is in the consumer and e-commerce sector, quietly scaling in one of the world's fastest-growing markets, using tech and logistics to serve a rapidly changing digital economy. Two industries, to very different business models, but both have one thing in common. They're showing real momentum, the kind that often comes before Wall Street catches on. Now, here's the interesting part. Both of these companies recently made moves that raised eyebrows among investors. One just announced a multi-billion-dollar long-term partnership deal that could transform how data and AI infrastructure are built over the next decade. The other has been reporting steady double-digit growth in revenue while quietly expanding its market share in one of the most competitive regions in the world. And yet, despite all this progress, neither name is getting the mainstream attention you'd expect. So today we're going to break down what's driving this sudden wave of investor interest, why their business models might be worth a closer look, and what these new developments tell us about where tech and consumer markets could be headed next. Because here's the truth. The stock market isn't just about finding what's popular. It's about spotting potential before everyone else does. Now let's be real for a second. The hype around AI has been off the charts this year. From chip makers to cloud platforms, everyone's trying to stake their claim in this next technological revolution. But there's a lesser-known part of that ecosystem. The companies actually building and powering the data centers that will handle the next generation of AI computing. Think about it. All the algorithms, all the machine learning breakthroughs, all that processing power, it has to live somewhere. And that somewhere is inside data centers that run on massive energy capacity. The companies behind those facilities aren't just infrastructure builders. They're becoming key players in the AI gold rush. One of the stocks in today's video is part of that story. It's been signing massive partnership deals, expanding power generation, and even catching the attention of big tech backers. Before we dive in, please take a second to hit the like button, share it with your friends, and subscribe. Please help this video get at least 500 likes. It really helps support the channel and keeps us bringing you the latest market insight. Thank you. Remember, this is not financial advice. I'm not telling you to buy or sell any stock. We're just analyzing what's going on so you can make informed decisions for yourself. Have you ever seen a stock jump nearly 17% in one day and wondered what on earth is going on? We are talking about TeraWulf, Nasdaq. Wolf. Now here is the big question. Is TeraWulf setting itself up to become a serious player in the new AI-powered infrastructure boom? Or is it biting off more than it can chew with all this debt and expansion? So first off, why did TeraWulf stocks soar 16.8% on Tuesday, while the S&P 500 rose just 0.2%? and the Nasdaq Composite climbed 0.8%. TeraWulf exploded upward after announcing that massive 25-year, $9.5 billion data center deal. That's huge, especially for a company of TeraWulf's size. This deal involves FluidStack, an AI cloud computing provider. Together, they're developing a 170-megawatt data center in Anson, Texas, designed to handle heavy AI computing workloads. And here's the twist. TeraWulf will own 51% of the project, meaning it keeps majority control. Even more interesting, the contract comes with a $1.3 billion backstop from Alphabet's Google, helping TeraWulf secure the financing it needs to actually build and operate this massive facility. That kind of backing doesn't happen every day, and it explains why Wall Street suddenly woke up to this small-cap name. So what does this partnership really mean for TeraWulf? For one, it's a bold step into AI data infrastructure, expanding beyond just Bitcoin mining, the space where TeraWulf originally made its name. A 170-megawatt facility is serious capacity. We're talking about computing power on par with the kind of data centers used by top-tier AI firms, and the 25-year term gives the company long-term visibility, something investors love to see when it comes to recurring revenue streams. The company expects Phase 1 of construction to be completed in 2026. That's not overnight, but it positions them to benefit from the AI infrastructure boom we're seeing across the tech world right now. So yes, the deal looks amazing on paper, but investors should keep an eye on how the company manages its debt load over the next 12 to 24 months. Now let's dig into the numbers because that's where things get interesting. For the second quarter of 2025, TeraWulf reported revenue of $47.6 million, up from $35.6 million in the same quarter last year. That's a solid 30% increase year over year, showing clear growth momentum even before the new AI deal kicks in. But at the same time, cost of revenue excluding depreciation also jumped from $13.9 million to $20.1 million. That tells us expenses are scaling up as the company expands, which is expected. But it also means margins are under pressure. Meanwhile, the company's Bitcoin mining capacity grew 45.5% year over year, hitting 12.8 exahashes per second. That's a big jump and positions TeraWulf among the more efficient miners. In North America, this growth in hash rate shows TeraWulf's infrastructure investments are paying off. But mining alone isn't where the story ends anymore. Let's look deeper into the non-GAAP results, which give a clearer view of operational performance. In Q2, TeraWulf self-mined the 185 Bitcoin at its Lake Mariner facility compared to 699 Bitcoin in Q2 2024. That decline is expected due to the Bitcoin halving event in April 2024, which cut block rewards in half. TeraWulf also strategically divested its Nautilus cryptomine facility back in October 2024, slightly reducing total capacity, despite mining fewer coins. The total value of self-mined Bitcoin was $47.6 million, nearly flat versus $46.1 million a year earlier, thanks to higher Bitcoin prices. Here's the flip side. The expansion comes with massive costs and high leverage. Even though the headlines are exciting, some analysts are cautious. TeraWulf already carries substantial debt, and taking on more to fund big AI data centers could be risky if AI demand slows or if the industry overbuilds capacity. If that happens, smaller players like TeraWulf might be hit hardest. Finally, adjusted EBITDA came in at $14.5 million, down from $19.5 million the prior year, highlighting margin pressure. And now let's talk about the big money moves in October 2025. On October 29th, TeraWulf announced it upsized and priced a $900 million convertible notes offering. Just a day earlier, it revealed the 168-megawatt AI compute joint venture with FluidStack. These deals bring funding and attention, but they also increase dilution and leverage, meaning volatility is likely. Next is Ding Dong Cayman Limited (DDL). Ding Dong, founded in Shanghai in 2017, operates an on-demand fresh grocery e-commerce business in China. It offers fresh produce, meat, seafood, ready-to-cook meals, snacks, all delivered through frontline fulfillment stations and online channels. In China, speed, freshness, and supply chain control are major differentiators. Recently, the company announced a $20 million share repurchase plan, a sign of management confidence. For the quarter ending June 30, 2025, revenue was 5,975.9 million RMB, 830.2 million, up 6.7% year-over-year. That growth is meaningful given China's competitive grocery landscape. Product revenue rose 6.8%, while service revenue grew just 1.3%, meaning the core grocery business is still the main engine. The company attributes growth to more orders, higher order frequency, and more fulfillment stations. Though offset by the suspension of some stations in 2024 and price declines in some categories, cost of goods sold rose 8.6%, pushing gross margin down from 30.0% to 28.8%. That's a margin squeeze. Not ideal, but partly due to the company's 4G strategy focused on product quality and service. Fulfillment cost as a percentage of revenue improved from 20% to 21.7%, a positive sign that the network is becoming more efficient. Net income from operations rose to RMB 81.6 million. $11.4 million, and non-GAAP income rose 14.1%. Net income reached 107.2 million RMB, $15 million, and EPS improved accordingly. The company's available funds, cash minus short-term borrowings, increased to 2.95 billion RMB. Over $500 million USD. That's a major strength. Ding Dong is one of the few Chinese e-commerce players, showing both GAAP and non-GAAP profitability along with operating cash inflow. Non-GAAP margin improved from 1.8% to 2.1%, but margins remain thin, and risks remain. China macroeconomic uncertainty, competition, and cost pressures. Ding Dong is a high-potential, but still speculative business, solid execution, strong cash, but narrow margins. As always, This video is for educational and informational purposes only. It's not financial advice, and I'm not recommending that you buy or sell any stock. Always do your own research. Study the numbers and understand the risks before making any investment decisions. If you found this breakdown insightful, don't forget to like, share, and subscribe. It really helps support the channel and keeps the weekly analysis coming. And if you'd like to stay updated on emerging opportunities and market insights like these, make sure to hit the notification bell so you don't miss the next upload. Thanks for watching, and I'll see you in the next one.